Hello students, welcome back to IBS. Now we will learn about the long-term liability. Liability that are not due for payment within a year, within 365 days. It is not due. It is due beyond that after 365 days or more than 1 year. After 1 year if it is due for a company operating cycle. As the same formula for current liability, but the point here is if it is below 1 year and operating cycle, if it is below that will be your current liability. If it is more than that, due part is more than that, then it will be long-term liability. This is the simplest definition. There are few examples of long-term liability: long-term notes payable, bonds payable that will not mature current year, that will mature after 1 year. Long-term portion of debt, any remaining balance for long-term for capital lease or any other, that will be considered under non-current liability. Pension obligation for any employee, you need to pay him when he will retire, but since it is not retiring this year and he may be retire after 10 year or after 20 year, but since he is working for you for 30 years, he has completed his 10 year, still he is 20 year far from his retirement. For 10 years you need to book their pension obligation, because even though if he retired this day you have to pay him, but since he is not retiring, so this is your obligation and liability, but it is not immediate liability. So, and we don't know whether he is going to resign or something, so that is why it will be again considered under long term liability. Pension and obligation, similar way, long term deferred tax liability, anything we are going to pay to government in future period after 12 months or after 1 year, so that will be your deferred tax liability. That is obligation, and there would be deferred tax asset in case if we have paid extra cash to government compared to our financial net profit. Warranty and obligation, cost expected from warranty claim. If you have given any warranty or something and he may claim to you, if it is again more than 12 months, after 12 months or after 1 year, if it is going to claim, that will be long term. There is any portion you are expecting average they are normally claiming, those portion you can keep into your current liability section. Advance long term commitment, any long term commitment you have made and you have created your obligation, so you have to pay him, so that will be your long term. The payment received in advance for goods and service to be delivered after 1 year. Basically you have received the cash or something, but you need to deliver the service after 1 year. That is mostly possible in case of construction business, and where you may take 5 year or 3 year or 2 year to complete those tasks. So that is why that will be in your long term liability section. Long term deferred revenue, deferred revenue is simply your revenue received but not earned. So the point here is you have advance bill, you have generated the bill in advance but you have not delivered the service. Revenue received but not earned within current year, you are going to recognize revenue after 1 year. Basically what we are doing here is we are booking AR account, we are debiting and we are crediting our deferred revenue in long term liability section. It will be, so this deferred revenue will remain into your balance sheet, because one side you are increasing your current asset, or you may categorize it to a non-current asset also, in case it depend on how the timing and all. Here it is deferred revenue in case you are not going to deliver the service or something within 1 year. If you are able to, then it will be again, it will be called deferred revenue, but that will be under your current liabilities. But similar thing will be in your long term, in case it is more than 12 years. If it is less than 12 months, that will be again current liability, but that will be considered as a deferred revenue. You have raised advance bill for that reason. When you complete your task, that time you will book your deferred revenue, you will debit and you will credit the revenue. So that time you are recognizing the revenue as per revenue recognition principle. We can recognize revenue only when we have rendered the service or we have delivered the goods. So since we have not delivered, we have raised bill only, and for that maybe if you receive payment, then what you will do, you will debit your cash and you will credit your AR part. Okay, likewise your balance sheet will not be impacted. You have received your cash, you have removed the customer account, there is nothing due from customer, but obligation is still remaining in deferred revenue, you need to fulfill that obligation. So in case of prepaid and other expenses like this one, you are giving insurance service or something, so you might receive maybe 120 for 1 year, and you will be keep on like how you recognize in prepaid. This is just a similar concept but in reverse mechanism. You will be keep on recognizing revenue every month. What would be your entry? You will always book deferred revenue, you will debit, and you will credit revenue for 10k. Likewise, every monthly entry you will pass and you will keep on recognizing whenever you're completing month. Once you complete entire 12 month, that time you will be after 10 into 12, you have already recognized all your deferred revenue for 120 and you have recognized your revenue 120. Since insurance period was 1 year and we have delivered the service within 12 months, if they have claimed, we will pay. If they have not claimed, then we are having rights to recognize revenue. Since period has been completed, now there is no liability in our end. After completion of that year, if he will renew, then our liability will increase. If he will renew, he will pay us again. We will raise him advance bill. Also, that time we will be booking those entry like AR2 again AR2 deferred revenue or renewal case, and when he will pay, that time cash to AR. Your AR will be nullified and your deferred revenue will be again remaining in your credit side liability section, and you will keep on debiting like this way and crediting your revenue monthly basis. So this is the cycle, always keep on working. I think I have explained to you deferred revenue. Always remember deferred revenue is just reverse mechanism of your prepaid expense. So that will help you to memorize the concept. If you talk about notes, long-term debt often has covenant and restriction. With the help of restriction only you are holding them more than 1 year. Otherwise, liability, everybody wants to receive their fund as soon as possible. But you are holding your client or your the person who is giving you cash or whatever service or something, and that is due for more than 1 year. So that will be restricted based on some kind of rule or restriction. Require digital disclosure of financial statements. For bond or any kind of such kind of stuff, whenever the company who is the issuer, he will issue for more than 1 year, maybe 5 year or 10 years, and he will give you the interest rate for that fund. He is getting fund right from you, and for that he will be paying you. But he is restricting you for 5 to 10 years, maybe government or any company. And if you are having option to call that, then he will reduce the interest and he will pay you. If you are getting this money after 5 years, so he hold you for 5 years to take the benefit of your cash, and that cash he is taking the benefit. For that he is paying you interest, and that they are holding you through the restriction. That is the point here we are discussing. Long-term debt often has covenant and restriction that require to detailed disclosure and financial statement. So this kind of restriction and kind of stuff we need to mention in our notes. Notes is also kind of financial statement. I hope it is clear to you. I'm trying to explain you every single thing possible. Okay. Thanks for watching. See you into the next session. In next session, we are going to learn about equity in depth as much possible. Stay tuned.